Welcome everyone to this Friday webinar. My name is Kamal Manocha. Thank you so much for your patience. We are starting 5 minutes delay. Thank you for being patient, and we'll be beginning now. This webinar is kept particularly to understand the house view of Abacus about mid and small cap segment. There has been a lot of action, which is a positive action in the mid and small cap space that we have seen over especially last 2 years. Massive wealth creation has happened, and this has led to many small cap mutual funds actually becoming reluctant in taking more money. They have stopped inflows. One of the fund house with whom we have done webinar 2 weeks ago, they have also stopped taking money. Equitas, I'm reminding you all, and we had this discussion with Siddharth Bhaiya in that webinar, whereby he was kind of showing a lot of pessimism, whereby he was kind of trying to give this indication that this space of small mid caps has actually gone up, and hence they are not comfortable. But at the same time, we know that equity has always been, giving us new learnings and new surprises. Nobody could have imagined during COVID, Nifties will go beyond 12,000 levels, and we actually saw a rally happening till 18,000 levels. I am personally of the view that this time there is something definitely which is significantly different as an underlying in terms of the growth driving this entire rally, and that is visible in the sense that valuations of large caps, for example, which is the main I would say sentiment setter for equity markets, is not expensive. It is like fairly valued at 20 to 23 PE, and forward PEs are also kind of quite attractive. Yes, small cap space in terms of valuations does look surpassing fair numbers, but I do feel that there are pockets in mid and small caps where further there is a massive growth for wealth creation, and I don't agree to this idea that there are one cannot find out or figure out opportunities to find out new multi-baggers in these markets. So that's the view that we have been maintaining with our clients, but at the same time we're also wanting to learn, and that is why we thought of keeping this webinar with Abacus. No better than Abacus, because Abacus has been delivering a lot of alpha, and it is an alpha focused fund house. So welcome, Aman, for this webinar. I have set the context for you. I'll be kind of maneuvering this over next 1 hour for you to kind of answer certain questions. But to begin with, we want to understand from you what are your house views in terms of whatever I have said in the current context at current levels of your target universe of businesses in your approach of value style of investing.
Okay, sure. Thanks, Kamal, and thanks everyone for joining in the conference. As Kamal mentioned, the context is about the mid and small cap. So let's take a step back to see as to what has happened on this space over the last 6-9 months and over the last 2 to 3 years. That will give you a brief reference as to what we have discussing about, and then we can take the outlook ahead as to what we feel as a house is the future for mid and small caps in India. So clearly last 7-8 months since April, markets have been in a roll in India, and mid and small caps have done very well in this phase of time. But this rally has not been just India. Since April, there has been a global rally. Almost all markets, regional as well as the global, in the developed markets are up, and India has its own share of participation in that. In fact, we have outperformed most of the other markets during this period because of the positives that we all know that India is facing right now. In this phase, what has happened is there has been a good amount of liquidity which has come in, both globally as well as locally. And locally, what we have seen is that there's always this phenomenon that the sector which is doing well, people chase that sector even more, and that leads to more inflows, and then that contributes even further towards the execution. So this becomes like a vicious circle that more money, mid caps did well, more money chase mid caps and small caps. Because of that, they continue to do well. Seeing them continue to do well, even further money is starting to come in. And this is the cycle that we are right now. But these are all technical factors, right? That money is flowing in. Ultimately, we are all fundamental investors, and we need to understand as to what is the right approach or what is the right way to look at the mid and small caps. Now, why do we invest in the mid and small caps? Very clearly, we invest for a higher return. We all know that mid and small caps are more volatile, not necessarily risky, but definitely volatile. But at the same time, if somebody has a patience, they have the potential to deliver a higher return for the simple logic that these are smaller companies, and hence from a smaller base they can grow faster. These are companies with unique business model. These are companies which are early in the cycle, and hence they can have a faster growth rate. They can scale up fast, and this will eventually reflect into the stock market return, and hence they would give you a better return. And many cases it is also the case that since they are undiscovered, the valuation here is lower versus what the market valuations are. And once these companies start to deliver, there will be a PE re-rating also. So you make returns by a combination of both earnings growth, which is faster, and a potential PE rating. So that's the whole story about mid and small caps. Now, has this story changed? No, this story has not changed. The fundamental for the mid and small cap remains the same. Then what is the worry? The worry is that have they become expensive that one needs to be worried about? We feel that it's not fair to club the whole mid and small cap basket or all the companies in that space with a single paint or with a single brush. Like the case in large caps, similar is the case in mid caps also. There will always be some pockets of stocks or sectors where valuations become frothy, where the stocks have done well and they are now expensive. And there will always be some pocket where there's still value, where there's still an opportunity. The way we see in large caps, we see that clearly in the last few years, cap goods have done well. In the last few years, consumers have done well. In the last 1 year, banks have not done well. So if you have to ask me, valuations are full on the consumer side, but there's still enough of opportunity to look into the financial space. Now, within the financial space also, a name like an HDFC Bank or a Kotak Bank will be trading at 3 times book. Somebody like an ICICI Bank would be trading at 2 times book, or IndusInd would be 2 times book, and somebody like a State Bank would be even lower than that. So there will always be categories of valuations. There will always be sub buckets of valuations. There will be always be sub bucket of stocks where one can select and choose. So ultimately, what it boils down to is that when you are investing, whether the risk reward equation is favorable. So at Abacus, we have this very clear view that we will invest only and only if we feel that the risk reward equation is favorable, whether it's a large cap or a mid or small cap. So right now, clearly, we are investing only when we feel it's the right time or it's the right value to put in. But having said that, clearly, mid and small caps have done exceedingly well. Last 1 year has been great for them, and hence they are not cheap. I'm not going to tell you that they're still cheap and hence there's enough of opportunity. No, they are not cheap, but at many places they are at fair value, and from fair value or slight discount to fair value, and hence they are not expensive either that one needs to be worried about that. Yeah, let's book profit and run away, or it's too scary to touch them, or it's too scary to deploy further capital into these names. There always be some pockets. For example, say in the last 9 months, defense as a sector or the theme has done very well. PSU as a sector or theme has done very well. Now, at many companies within these sectors, valuations have become full or even on the higher side, like EMS companies or say manufacturing companies. So these are some pockets that one needs to be careful about. One needs to be avoiding these sectors. One needs to be avoiding this momentum. But at the same time, there are enough of stocks within these sectors or in other sectors where valuation is still set 15, 16, 17 times 1 year forward, 2 year forward earning with a good 20-25% growth rate. And if that is the case, then it still makes sense to look at these companies from a good 2 to 3 year perspective. It can happen that in the near term, just because mid and small caps have done very well over the last 9 months, we can have a short period where there is a time correction or a phase where large caps do better than mid cap, but then that's going to be a short period. If somebody is investing with a 3 to 4 year view, then these are short periods of time correction or underperformance, which shouldn't be of a worry to anybody. Till the time the companies that you have invested into are doing fine, the price that you have paid for this company is reasonable, then I feel that it's just a matter of time that you let the market find its own course and the companies to keep on delivering, and eventually the performance of the companies will get reflected into the stock price and will be reflected into your portfolio performance also. So the whole debate of mid caps and small caps versus large caps is not meaningful. Ultimately, the debate should be whether the company that you have invested into is fundamentally strong, whether the company is doing well, and what is the valuation. What are we worried about? In the last 6-9 months, mid caps are done well. That doesn't mean that all the mid caps and small caps are expensive or all the large caps are inexpensive. And hence, we should be buying only large cap and not mid and small cap. Within large caps, there are buckets. Same way, within mid and small cap, there are also buckets. There are enough stocks that are still fairly valued. There are enough stocks which are lower than fair value, and there are stocks also which are more expensive now than what they were 6 months back, and hence they should be avoided. So that's the basic principle that we follow. That's what we have been doing in our mid and small cap portfolios.
Sure, Aman. Thank you so much for this nice introduction. May I please suggest to kind of align your camera angle, and then we'll move ahead.
Sure.
Perfect. So we have around 100 crore plus worth of clients in Abacus. Plus, obviously, your overall assets have kind of grown massively over the last 5.5 years. Your journey of almost 6 years with Abacus, after leaving Reliance, has actually been kind of very enriching for you. And today, you have also kind of made a name for your own self. So, I want to understand what is it that you and internally within Abacus follow as a process, or under thought leadership of Mr. Singhania, what is the overall, process like, we as advisors and our clients, are obviously, skeptical at this current moment because markets have gone up. We do not want any such mishaps to happen in future whereby markets are falling and, the values are actually going down, and there is no such, mechanism in place. Obviously, this is the difference between mutual fund and PMS. Because in mutual fund, the assets are so massive, the portfolios are so widespread that this can go uncontrolled. But if at all, in future correction happens, which obviously all of us understand, equities and asset class will go through corrective phases also. But how are you well prepared? How are you going to handle that? Is there a process, a culture, like, you guys are meeting once in a week, understanding valuations of your portfolio, preparing yourself so that next time when this correction happens, Abacus is able to deliver alpha even at that point of time? I want to understand that aspect.
So Kamal, there is definitely a process which we follow, and I'll explain that process to you. But that process is limited to the stock selection and the kind of stocks that we want in our portfolio. There cannot be a process wherein we are able to time the market or where we are able to time the performance of the portfolio. So our process is restricted to the fundamental investing that we do, and that process is pretty simple. See, broadly, there are 6,000 companies in India, out of which we feel around 1,500 companies are investable. Within that companies, we have a needs framework to shortlist the companies. We all know about the needs framework, but in a minute, I'll just give you a brief as to what framework that we use. The M in the needs framework stands for management, wherein we assess the management quality, the past track record. We do a peer group analysis of the management. The E stands for earnings. We focus on earnings growth. That is something which is very predominant importance to us. A company with only value and no growth is not something which we are excited about. So we clearly need a growing company in our portfolio. The second E stands for events and trends. These are the triggers. These are the catalysts. This could be a stock split, M&A, acquisition, some change in government policy, global policy, something which can act as a catalyst for the value to get unlocked or for the market at large to realize and understand the value of the investment that we are holding. The T stands for timing, not timing the market, but timing the earnings growth of this company. In a developing market like India, growth is not linear. The company's process or the business process is not something which is linear. It goes through ups and downs, and there's always some cyclicality involved in that. And this is where we would like to time. We will obviously prefer to invest in a company where growth rate is accelerating versus investing in a company where growth rate is decelerating. Or if there's a cyclical turnaround company which is currently maybe loss making and looking to turn around and make profits once the cycle turns, then we would like to invest closer to the turnaround rather than investing 2-3 years ahead of where the turnaround happens. So this is where the timing comes in. And finally, S stands for the structural opportunities, which a developing underpenetrated market in India has lots of tailwinds, especially with the consumer names or especially for the mass focus sectors that we would like to look into. So if the valuations and if the risk reward equation is favorable, we would also like to participate in the structural growth opportunities which a country like India offers. So this is the framework that we follow. So this 1,500 companies are looked through this meets framework that we have, and post this we have a short list of roughly around 350 companies. Now this is the universe that Abacus research team actively tracks. We have a strong 12-member in-house research team which the team members are divided with sectoral responsibilities. So each team member has at least 2 to 3 sectoral responsibilities, and they're responsible for tracking all the companies within that sector. So these 350 companies are tracked by us internally by our research team, and based off that, what we feel is that we have a funnel of almost 100 odd companies where we can invest. Out of this funnel of 100 odd companies, depending on the strategy, depending on the liquidity, depending on the market view, we construct the portfolio. When the portfolio is constructed, which is the case right now because we don't have any new strategy in place, so we have 3 strategies, and all the 3 strategies, the portfolio is there. There is a daily monitoring of the portfolio that happens in. So the research team, we all meet daily morning, and we discuss the portfolio, we discuss the events in the market. So that regular monitoring is there on a continuous day-to-day basis. Also, one very important thing that we do is that we don't invest unless and until we have met with the management, and unless and until we are clear as to what we are getting into. So there is no paper research that we do that on paper this company looks good and hence just go ahead and invest in that company. Unless and until we are convinced after meeting the management, after meeting the team out there, that this is a company worth backing into, this is a company and where the growth prospects are good, we'll not go ahead and buy. So we are in regular touch with all the managements that we have invested into. We interact with them at least once a quarter to just to see as to how the business is shaping up, how the projections that we have in our model, is there improvement in those projections, or there is some headwinds to those projections, and hence this is a regular daily monitoring process that we have, and that is an ongoing process. There is no time limits for that we'll do it in a result season or we'll not do in a result season, or we'll do it in a certain event or in a certain month. No, this is an regular process. Market is on daily, and so is this tracking, which is on daily. We have a 6 month review period. In this review period, if any stock is not performing for a certain reason, it could be internal, it could be external, it could be for some reason. If something is not performing, then we look at this company over this review period. If we feel that the underperformance is justified, it could be due to some temporary reason, or it could be due to some macro factor where the company has no control, then we would like to continue holding on to the investment. But if we feel that no, this company is not performing as to what we thought, to do whatever reason, that is something which is permanent, then it is better to bite the bullet and move out of that stock and use the cash more productively somewhere else. So this is what we continuously keep on doing for the portfolio that we have. By doing this, we are constantly aware as to what's happening with our portfolios, and we are constantly rejigging our portfolio and reviewing the underperforming names and replacing them with new ideas that we feel are more appropriate. And hence, at any given point of time, we know as to what the portfolio valuation is, how the portfolio is shaping up, what is the earnings growth of this portfolio. Having said that, what we don't know is that how is the market going to respond, whether it's going to be a flattish market, bullish market, bearish market, and how it is going to do the stock price performance, because that is something which is not in my control. So that there's no process to follow that. Say tomorrow there is some event in US, the inflation data there is different than what the street is estimating, or there's a Fed meeting in US, the inflation data there is different than what the street is estimating, or there's a Fed meeting in US, the inflation data there is different than what the street is estimating. Then we cannot control the inflation. There is no way, or there is no process
Your network is breaking in between. You might want to
to be.
check that.
Uh, how is it now? Is it? I'm audible now. I've just switched on your camera. Is it better now? Kamal, you are on mute.
Yes, I said this is better now.
It's
Absolutely.
better now? Sure. Okay.
Yeah.
Then I'll keep the camera off. I think that will be better. So
Okay,
what I was
perfect.
thinking that if there is some event globally in the US, if Fed comes and says that they're going to be an aggressive rate cut because they're much more comfortable with the inflation now than what they were in the before, then the markets can rally there. At the same time, if they have a very hawkish comment, then markets can correct. The same thing will get reflected in the Indian equity markets, right? There is no way, or there is no process to control this, or to, you can say, preempt this, right? So this is something that nobody can do. If somebody claims to do it, uh, good for them. At least we are not capable of trying to time the market. So there is no process for that. So If tomorrow markets were to correct for any reason, there could be profit booking or there could be some event, then our portfolio also will move along with the markets. This is not a portfolio which will move significantly opposite than what the market trends are. But over a period of time, this portfolio has a earnings growth which is better than what the market is. This portfolio has a valuation which is better than what the market valuations are, and hence this portfolio will outperform the market, and that is where the alpha delivery comes in. So that is what my role comes, and this is what the process that we follow. That this is the way we generate this alpha. So we are always comfortable with the portfolio that we have because we are continuously monitoring it, and the companies that we are closely monitoring it and continuously watching to it as well. Is there any risk to the earnings growth, or is there any risk to the investment thesis that we have built around to each and every company within the portfolio?
Sure, Aman, fair point. So, the subsequent question that comes to my mind is that yes, you have, explained in detail the MEETS framework and how you are kind of, reviewing your portfolio and kind of getting rid of underperformers. But at the same time, does Abacus over time has conceptualized how you guys may want to take cash calls ever, maybe for 20%, 10%, 15%, during exceptional scenarios? Though I agree that, at present there is no such alarming exceptional scenario, but if at all that happens in future, are you guys prepared, and have you ever thought, or has this been part of your overall process till date?
So we don't take active cash calls. That is not something. It's like indirectly trying to time the market. So that's not what we do. At the same time, what we do is we don't have a you can say static or a standard model portfolio concept. For example, we don't have a model portfolio which says that on Monday, if I receive money, on Tuesday that money will get deployed in the market based on the model portfolio that I have. So this we pick and choose each stock that comes into the portfolio, and we take time to build the portfolio. So to give you an example, say any new client which has come to our PMS over the last say 6 months, today would be say around 70 to 80% deployed. Any client who has come in the last 6 to 12 months would be 90-95% deployed, right? So we take time to deploy capital because we would like the entry price for the stocks that we have purchased for each and every client to be favorable. So if some stock has which is existing in the portfolio but it has moved up very sharply in the near term, then we would like to wait for that stock to come at a comfortable level before we re-enter, or else we prefer to get into some other stock. And for that reason, we don't have a very static model portfolio. So this is the way we ensure that the valuation comfort is there into the portfolio, and the portfolio which we are building for each client has a decent risk reward equation. As I mentioned, we don't take cash calls. This is the only process that we follow to ensure that our entry levels are reasonable for each and every client portfolios that we have.
Sure, Aman, fair. So you may want to switch on camera, and let's see, if you can continue like this.
Yeah, is it better now?
Yes, better.
Sure.
So you mentioned a very pertinent point about the quality of the portfolio, whereby valuations are low, earning growth is high if compared to the market, and hence, if any correction happens, which is the nature of equity as an asset class, the portfolio will be able to kind of withstand that over time. So I want you to kind of explain that, overall in the present context of the current portfolio. Say, let's talk about your EOP portfolio. What is the current, I would say, overall trailing or forward P and earnings growth in that context, and then maybe you can cover the all cap portfolio as well.
Sure. So for the emerging portfolio, which is a combination of mid and small cap stocks that we have, the current valuation will be around 15 to 16 times FY25 earnings, right? This is 1 year forward earning. And this is in context to, you can say 18, 19 times or even 20 times for the benchmark or for the broad market valuation. So we are decently valued compared to what the benchmark valuation or the market valuations would be. We have a 25% earnings growth CAGR in this portfolio over current year till FY25. And the debt equity ratio of this portfolio is less than 0.2, and that's with a decent ROE of 16%. So that's what the portfolio constructed. So this portfolio has earnings growth, which is better than what the consensus or the broad market earnings growth is. At the same time, valuation is lower than what the market valuations are. And the reason we are able to achieve this is by a simple fact that the style of investing that we follow is the value conscious style of investing. So while we are not a pure value investor that will go ahead and buy a 5p stock or a 6p stock or a 5% dividend yields company, at the same time we are value conscious that I don't want to pay an abnormal premium or an unjustified premium just to get into the market leader or the market popular stock or something that is in fancy. So I would like to be very, you can say, risk averse to paying a very high premium in the market. And because of this, the obvious high P names most of the times don't reflect into portfolio. So we have very little exposure to consumer names because most of the stocks in this segment is on the higher side. At the same time, uh, stocks where the valuation is pretty frothy, like say, many capital companies which trade at north of 40, 50p. We have this EMS companies, they all trade north of 60, 70p. Some of the defense companies, some of the PSU names, just because they are in the railway segment or some segment which is doing well over the last 6 months, they are all trading north of 40, 50p's. This is not something which we look at or we are comfortable investing into. So we are more comfortable with investing into sectors and stocks where the risk reward equation is balanced. There is a decent growth and a decent valuation. We don't want to overpay. And because of this reason, the portfolio value because the top quartile of the expensive stocks is something that we are comfortable with. And because of this, we are very comfortable that that company will trade at a premium. We are ready to pay a premium. Don't get me wrong. That we always need a discount. No, we are ready to pay a premium, but the premium should be justified. The premium should be worthwhile to consider. Is what the message I would like to give you.
Has this ever happened, or or do you anticipate kind of stop taking money for EOP or any other portfolio, or advising that yes, this is the time where kind of we are kind of what shutting down this strategy for the time being?
No, we don't follow that process because it's indirectly time to time the market, right? And also it is counter logical that I say that I don't want fresh money, but at the same time I'm comfortable keeping money for my existing clients, right? Because they also fully invested, they're also taking an equity exposure, right? So if somebody is invested with me for 100 rupees, his investment is same as to the 100 rupees that I'm going to get from a new client, right? So to the new client, I'm saying no, I won't take fresh money. But the old client, we said that no, we are okay to come to take this. This concept of stopping money makes sense where you find liquidity as a concern. That fine, you like your stocks, you like your portfolio, but you're unable to deploy more capital into the same name or in the portfolio for whatever reason, and hence you stop money. Only in that case, this makes sense. For us, at the portfolio level, since we run diversified portfolios, we have a 30-35 stock portfolios on the opportunities side. We are comfortable with the liquidity position that we have. So we don't have a 5, 10, 15 stock very concentrated portfolio where liquidity could be an issue. And we have a risk matrices in place. So we have a single stock limit of 10%. We have a single sector limit of 30%, which we don't breach, which we are pretty, we can say, uh, disciplined in following. And hence, this thought of uh, closing subscriptions is not something that we have actively considered. There can be, you can't say never, it won't happen never ever in markets. In a situation where we feel there is a liquidity constraint, in that scenario, we can think over this, but at least as of now, there is nothing on the discussion board.
Sure. What is the house view otherwise of Abacus, or your personal opinion to the market, I would say, opinion these days, whereby everybody is saying investing in large cap in at present levels is more lucrative, or is more, I would say, advisable than maybe investing in mid and small caps?
So as I started with my conversation today, that it's just a matter of time. It could happen in the next few months. Mid and small caps might not they have a time correction, or they might underperform the large cap names just because in the last 9 months, 10 months, mid and small caps have done very well. So it's more of a mean reversion than any trend that one should be looking into, and that's what we follow. Our house view is very simple. Whether it is large cap or a mid or small cap, there will always be some pockets of stocks where the valuation is expensive. There will always be some pockets of stocks. There is still an opportunity to make a decent return, and that is where our focus lies. So whether it is a large cap or a mid and small cap, this focus of us doesn't change. Having said that, we have had a great run since April of last year. And while the outlook for Indian economy as well as the market is good, uh, we feel that from these levels, because the markets now are fairly priced, it's not a cheap market anymore. At 21,000 Nifty levels, we are decently priced. We are closer or slightly above the 10-year average. Hence, from a fairly priced market, the return expectation also should be fair. The kind of 30, 40, 50% return that we have made in the last 1 year, it will be difficult to replicate them. If it happens, more than happy, but at least that's not the base case scenario that we have. We feel that from the fair market level that we are right now, one should be expecting a fair return from the markets, which is something around anywhere between mid-teens to high-teen kind of return. These returns are not going to be linear the way equity markets are. We all know that we need to have a 3, 4, 5 year patience for this returns to get delivered on a CAGR basis. But from these levels also, we are pretty positive and optimistic that Indian equities will deliver a decent return for investors.
Sure, Aman. So we move on to the subsequent part of our webinar. So first part is done, whereby I want to understand your views. Let me also understand from you, over last 5 years of your journey with
Yeah.
Abacus, and especially last 3 years where Abacus has done really well. What is your own personal assessment? What is your self-assessment of the performance if you compare your strategy with a lot of other strategies? Obviously, Abacus has done very well. It is definitely amongst top 10. But there are a lot of other strategies which have done even better in last 1 year, especially, or last 2 years. So, if you were to kind of, create your own scorecard, given the kind of segment you are in, there are a lot of other players, if you were to do that SWOT analysis or that competitive analysis, that competition analysis, because, investors keep comparing. Investors would have come to Abacus at different times. Obviously, those investors which came at the beginning have made a lot of money, but those investors who came in 2022 or have just come in last 1 year have not made that much returns. They have not seen your 3 year returns. They have seen maybe last 1 year returns or 2 year returns, and then when they compare with a lot of other strategies where more wealth has been made, they are kind of wanting to kind of understand your own assessment of your performance, especially in the last recent bull run which has happened, whereby Abacus has relatively, I would say, not done that well. I can say it has relatively underperformed if compared to its peers. So what are your remarks to that aspect?
Sure. So you're right in your assessment that people coming at different points of time would have a different experience and a different expectations. As far as we are concerned, we monitor ourselves on a daily basis, but at the same time, our assessment is over a period of time. And we also very clear that the way market returns are not linear, our strategy returns are also not very linear. So we are not running a fund where the strategy is flexible. For example, as I told you, in the last 6, 9 months, PSU stocks have done well, defense companies have done well, railway stocks have done well. There are certain pockets of companies that have done well. Now, do we like this segment? Do we uh, are we are they our favorites? May or may not be. So there will always be some periods of time where the philosophy that we have, which is a value conscious style of investing only into those sectors where we find a good mode, where we find a good understanding, and focusing on that may perform or may not perform, right? But we can't be changing our strategy every 3 months, 6 months, 9 months just because the market momentum is changing. Because the market sectoral preferences and momentum will change on a regular basis. Whether it's a bull market, bear market, or a flat market, there will always be some sectors that will do well in the near term. There will always be some other sectors that will do well over a period of time. So we focus on doing what we know best. We focus on doing what we believe in, and that is what we will continue to do. There will be periods where our style of investing might not be the best style of investing, or there will be times where we have done well in the past and there could be a year where there is mean reversion and some other strategy does well, and then again our style of investing comes back. For example, if somebody follows the momentum style of trading, then in the last 9 months he would have done much better because he will be continuously churning his portfolio and he will be continuously getting into new sectors, new names, and that is what the market has rewarded. At the same time, there could be strategies or there could be sectoral focus funds. Anybody who's invested into PSUs or anybody who has invested into government companies, they would have done significantly better in the last 8 9 months versus any other portfolio, any other sectoral preferences that we have. Or somebody who has focused, say, at just large cap banks, they would have underperformed because most of the large cap banks have given zero return over the last 12 months, while the market has given you a return and the mid and small cap has given you a 30 40% return. So that is bound to happen. We can't be chasing blindly chasing returns every week, every month, or every year kind of thing. What we have to focus is that whether you're following a disciplined approach towards investing, whether you're true to the style that you believe you're good at, and whether you're diligently doing the investing the way you feel is more appropriate towards the way we would like to invest. So that's what we look at. So if you look at 1 year, maybe relatively there will be other funds that they have done better than us, possible. But if you look over a period of time, I believe we'll be in the top quartile, and we have delivered a decent alpha. Going ahead, also there can be phases, there can be months, there can be quarters where others do better than us. Very much possible, and at the same time, it's not that I'll be at the top all the time. There will be 40, 50 uh, decent PMS houses. They all would have multiple schemes, so there are 200 300 schemes. Out of the 300 schemes, there will be only one or two schemes which will be the top one or two. Some balance 200 schemes will be lower than that, right? So I can't claim, or that's not my focus, that I need to be at the top. I need to be at the top quartile is what my focus is. Deliver a decent alpha and not take unnecessary risk. So the returns that we see also has to be looked to through the lens of risk adjusted return. So if somebody is ready to take a much higher risk, if somebody has a very concentrated portfolio, somebody has a very sectoral focused portfolio, those portfolios tend to do well in certain periods of time. And there is nothing wrong. That's the way market is. So it's to each comfort as to what style, what kind of strategy they would like to be invested into. We clearly have stated our philosophy. We clearly have stated the style and the strategy that we are following. And we have been following this diligently ever since the inception of Abacus 5 years back till date, and in the near future also. We will be diligently following the strategy that we have. That strategy will do well. Some months may not do well, some months, but that's the way the markets are. So we'll stick to what we do. So we'll not have a mid cap portfolio, and just because we feel the large cap will do well in the near term, have a HDFC Bank in that portfolio or have a high TCO lever in that portfolio. A mid cap portfolio, even though portfolio is done well, will remain a mid and small cap portfolio. Or a large cap portfolio will remain a large cap portfolio. We will not like to add more mid cap into that portfolio just because the mid and small cap are doing well. Because ultimately the client has come to me seeing the strategy, he's seeing the portfolio that I have considered, and I should be loyal to that. I should be honoring the strategy that I have communicated to the client. That strategy returns is what somebody should be looking at any given point of time, rather than just absolute returns based on an Excel sheet which gets sorted as to who are the best performers. So this is what I would like to communicate to both existing as well as potential clients who are looking at us, that uh, look at our performance based on the style and the strategy that we have, and this is something that is going to stay with us.
Sure, Aman, fair point. So let us, now understand from you, because being a fund manager, you're first equity research, person. As you rightly mentioned, that the overall segment of 1,500 stocks, again, the short list of 350 stocks, and then from there you have your portfolios, right? So where is it that you see currently still there is a uh, great opportunity to continue creating wealth, sector wise, stock wise, business wise? What are the kind of thoughts, in that regards, if we have to kind of navigate this entire opportunity and understand more from the point of view of you as a research analyst, not as a fund manager? Forget that now you are a fund manager of Abacus, but we want to understand, more from the point of view of you as a research analyst, in this regards.
Sorry, Kamal, I didn't exactly get you. Listen, you're trying to ask me that as to if I'm a research analyst today, as to what is the market scenario and what kind of stocks and what kind of opportunities are in the market. Is that right?
Yes, exactly, absolutely.
Sure. So if I'm a research analyst, if I put the hat of a research analyst today, where do I see the opportunities? Clearly, I see opportunity in the financial space. Uh, Post COVID, the credit growth has been good. The financial sector in India has been able to handle the NPA fear of the COVID times, and they have come out well. No economy can grow without the banking sector or the financial sector participating. So if you are expecting a 13, 14, 15, whatever that number is for the GDP growth, the financial sector also has to participate, and they'll also see that kind of credit growth, and they'll see that kind of earnings growth in that sector. And this sector is still decently valued. So we see good opportunities within this sector. So this is something where there is still decent value and decent opportunity to invest. We are also seeing opportunities in the pharma space. This is one space that has been seen ups and downs. They had a very good time during COVID, post COVID. Then we had time correction as well as multiple correction in this sector. And then we had the margin headwinds coming from the US markets, which is now stabilizing. And hence, pharma is also starting to look good to us. We are neutral right now, but very closely monitoring two sectors, which is IT and chemicals. In both these sectors, there is near-term headwinds. At the same time, both these sectors have companies that have great management, where India as a country has a competitive advantage, where the companies that operate into, they have a sustainable moat and good business model and good profitable business model. But in the near term, they are facing some headwinds. For IT, there is a slowdown in the discretionary spend, and hence they are facing a slowdown in chemicals. Globally, chemical prices have corrected because supplies are, can say, commenced from China, and because of that, the high prices that we saw during COVID and post-COVID is now getting adjusted, and hence there is a margin headwind towards these two sectors. We feel in the next 1 to 2 quarters, things should start to bottom out, and hence we are very closely monitoring these two sectors. The same thing we are experiencing with the consumer durable sector. This is something which is a quasi-consumer theme in India, and as we see most of the companies have seen demand slowdown because the bottom of the pyramid demand in India has got impacted. So while in the last 2 years, because of high inflation, maybe your and my life has not changed, but the people at the bottom of the pyramid, their life has definitely changed. Not just in the rural market, but even in the urban markets. People say, like our staff who earn anywhere between 10, 15, 20, 25,000 rupees a month, their lifestyle has changed because the inflation has hit them, and thus that demand slowdown is visible in many of these names. Having said that, with central elections due in the current year, we feel there can be a sentiment as well as a demand shift in this segment, because we all know ahead of the elections, the money supply in the economy goes up. There is good amount of spending that comes in, and that would help the demand pick up in this segment. So this is also one sector which is looking interesting. The valuation is here though on the higher side versus say chemicals or the IT sector, but there can be a clear earnings re-rating or a earnings growth opportunity in this sector. So this is something that we are focused on. Real estate as a sector has been doing well over the last 2 3 years. We expect this trend to continue for the next 1 to 2 years at least. So while we don't have a direct real estate exposure, we have indirect exposure via say laminate company or via a cement company or via a sanitary ware company, or maybe a plywood company or a tile company or something like that. So we have quasi real estate players in our portfolio. This segment is also looking good because uh, soon there can be rate cuts in India also in line with what the global markets are. And this is a phase when real estate does well because when your housing loans become cheaper and there is a demand push up, it happens. So we would like to focus on this segment also. So these are broadly the pockets where we are still seeing opportunities, which we are still seeing decent growth as well as a decent balance of growth and valuation in the markets.
Sure, Aman. So while you mentioned there are certain headwinds, for IT and chemicals, though you are liking these sectors, can you please kind of explain, especially for specialty chemicals, what headwinds are you kind of talking about here?
So basically, the headwind is simple that the end user prices for the specialty chemicals, and that is true for the base chemicals also, have been correcting. So, say if a chemical price was priced at 100 prior to COVID, when COVID happened, this 100 become 300. That 300 was because there were supply disruptions. After supplies resumed from China, this 300 has started to correct and has come all the way to 200. And it can further correct, maybe 100 or go back to 150 or 100 levels. We don't know. But this correction from the price is what is getting reflected into the margins of this company. So during this phase, when 100 moved to 300, all the chemical companies reported margins which were 2x of what the normalized margins were, and they were reporting good, healthy top line because there was volume growth also and there was realization growth also. Now the reverse is happening. Since the prices are deflating, even at the same volume, your turnover is dropping at 20-30%. And because the prices realization is lower, the margins are also getting compressed. And this is the headwind that they are facing. So many companies are countering these headwinds by expanding into new regions, expanding into new product categories, setting up new, more efficient factories, and trying to counter the headwinds. And at the same time, there are many companies who are focusing on changing the business mix. So earlier, if you're into say a dyes or a pigment, you now want to get into a different kind of specialty. If you're chlorine based, now you want to get into a different chemistry of chemical. So Indian companies are also innovating. They are also trying to mitigate this heading as much as possible. And this is not something that is going to stay forever, right? The way we had an upcycle, right now there's a down cycle, but very soon it will bottom out because no chemical company will operate at negative margins or will operate if the spreads are not good enough. And chemical is a sector in there is a natural shift of demand which is coming. So people want to defocus the China plus one strategy, which we all know. People want to defocus out of China and focus more Indian companies. So we are seeing, you can say, demand moving away from China into other geographies, into other economies. And India is a big beneficiary in the chemical sector because we have the talent pool and we have the infrastructure base in place. At the same time, we don't have very stringent environmental norms, which is one of the big reasons why chemical companies are moving away or they're closing their plants in the European or in the US region and moving to Asian economies. So we have this global strategic advantage in this sector, and hence we feel that once this headwind of margin pressure fades away, these companies will again start to report decent earnings growth, and that same will get reflected in the stock price also.
Sure. Over last couple of years, power as a sector has done really well, and within that, alternative energy kind of focused businesses like Suzlon, Inox Wind, which are like, you can say trying to create differentiated positioning in this sector are have done really well. Has Abacus kind of participated in this rally or missed this, and what are the views ahead?
So there are very few handful of companies which have a meaningful, you can say, alternate energy exposure. So we do have exposure into the conventional power sector, and we have, you can say, small indirect exposure. Like we would have an EPC company which is into solar installation, something like that, rather than having a direct, you can say, EV exposure or a direct non-conventional energy exposure. So we do have exposure, but yeah, but the exposure is not significant exposure because there is a limited number of names and a limited amount of liquidity which is there in these names. At the same time, since there is limited liquidity, the valuations here are also on the higher side. So one needs to balance that out. So while we have participated in the sector, uh, and we are happy with the holdings that we have because anyway, we uh, we run diversified portfolios. So even if I like a sector or if I like a company, I don't go overboard. I not have a 20-30% exposure into a small sector. So it's been a decent exposure to us, and the stocks have, I believe, have done in line with what the overall sector performance has been.
Sure. While in all our webinars we do not mostly cover stock specific questions, but there is one stock which I think we would like to hear your views about, which is Polycap, because it is in your all cap portfolio, and there has been a fall of almost 30% in the stock from its highs. So as you mentioned, there are daily meetings that you do and discuss the entire portfolio. The day that news came, how has your reactions been? What was discussed, and have you trimmed positions or averaged out on this stock? What are your views? What are you doing with this stock at the moment?
Right. So you also mentioned that we don't discuss stock specific, and I would like to keep it that way that we don't want to discuss stock specific. All I can tell you is that not just this company, any company where there is a positive or a negative news flow, the same gets discussed on the very same day, and we take appropriate action at that point of time with regards to the portfolio. At the same time, it is not necessary that we'll react to each and every news flow that comes in because we have to final information. So there is no final outcome towards it. You just make a statement that we have done a certain search or we have done a certain inquiry kind of thing. That doesn't state anything, because at the end of the inquiry, at the end of the search, you might come out with an outcome which says that nothing was wrong or everything was fine, right? So till the time we have clarity on what the exact issue is and how, you can say, severe the issue is, it is very difficult for us to react to each and every news like this for the portfolio companies. But having said that, we are pretty mindful of the events. We are also practical enough that we can't be waiting till the last man to react, and the whole train has moved on and you are waiting for the right opportunity and waiting for the full clarity. So it's also an assessment as to the initial work that we had done when we invested in this company, over the management, over the auditors, over the practices. We read all the annual reports of our portfolio companies. So every year we know as to what the numbers are. If we feel there is a red flag anywhere, we would like to take a preemptive action towards that. And we are very closely monitoring things. So it's not just the company that you mentioned, even other companies in the portfolio. If there is any event, positive or negative, we do take appropriate actions immediately.
Sure. In the overall, conversation over last 15 minutes, you have mentioned your quite optimism for financial services because you feel that that has not participated, and I agree with that. So, has this optimism also reflected in taking actions in the portfolio in terms of increasing weights through certain stocks? And can you please give an example?
Right. So we have increased our exposure to non-fund based financials in the last few months. So we have got into wealth management companies. We have increased our exposure to NBFCs. We have increased our exposure to a housing finance company. There will be some private sector banks where we have added in some portfolios one or two new names into the portfolio. So earlier we were restricted ourselves to the top two or three private banks. Now we are also looking at number four, the number fifth player in the private banking space. So yes, we have taken action. At the same time, there are certain segments that we are positive on, say like gold finance companies or microfinance companies. So within that sub-segment, we have taken either a new exposure or increase the existing exposure that we have.
Sure. So today we saw, after I think a gap of almost 2 years, that IT sector was a reason for market to go up. Primarily, all top IT weighted stocks kind of, did really well. And you said that there are certain headwinds, though you are kind of looking at it bullishly. So, what was your reaction, today, or are there any, I would say, uh, iterations or kind of changes in the portfolio in this regards for this sector you are planning in your portfolios?
So say like for IT sector, once there was a slowdown and once we saw that coming, we also took a reassessment as to what exposure do we have in the portfolio. We saw that in most of the portfolio, the IT exposure was in single digits. We also decided that we are not going to add any new name to the portfolio till there is clarity. We also took an assessment of whether it makes sense to completely exit some of the names or to trim some of the holdings. So wherever the IT exposure was higher in whichever portfolio, say it was more than 10, 12, 15%, we trimmed that exposure. We decided we'll not take any new name into the sector. So these are the actions that we keep on doing. So we are all I can say is the portfolio are very actively managed in that sense. So while we don't trade, while we take a 2 to 3 year view in whatever we do, at the same time we actively manage and we actively invest in whatever we strategies that we have.
Sure, Aman. So, I am reading the chat and I would just like to give one piece of viewpoint, based on my last 2 decades of experience. A lot of people in the chat seem to have kind of believed that, yes, correction is absolutely imminent and it is coming. Obviously, correction is the nature and characteristic of equity markets, but I can tell you correction will happen when it is least expected. Let me remind you, today markets have gone up. Nifty is up by 250 points. So people who are actually kind of just waiting for correction may be surprised because there are a lot of positive events which are expected to unfold over next 6 months, and markets kind of can keep on with the momentum. Obviously, as a fund manager, as Aman rightly mentioned, they are quite cognizant of valuations, and where valuations are expensive, they are kind of themselves booking profits, kind of reducing positions and realigning positions to where there is a valuation comfort. And at the same time, obviously, they are staying away from those companies which are like not showing growth in earnings. And we have seen over last 1 year, many such segments of markets have also done well, and maybe that is one of the reasons why maybe Abacus would have relatively underperformed. But in long term, this style, which is like proper approach of balancing value as well as growth, does well, and that is where experience to the investor in long term matters. So this is what I kind of conclude in this entire conversation, and I firmly believe that yes, there are always opportunities to keep creating wealth in the equity markets, and as and when there is a correction, if at all it has to happen in future, it will happen. Nobody can control that. It is the responsibility of investor to kind of take cognizance of his own asset allocation, and that is where we as advisors definitely add a lot of value, and we have been doing very good work with all of our clients. And I welcome anybody and everybody who want to kind of join PMS AIF world to kind of have this insightful interaction or insightful journey and experience of wealth creation going forward. Thank you everyone for joining with us today for this insightful webinar. Thank you, Aman, for your remarks and insights. We'll again connect soon. Thank you and happy weekend.
Sure. Thanks, Kamal, and thanks everyone for joining us today. It was a pleasure interacting. Sure. Have a nice day ahead. Thank you.
Pleasure.